I have with me Robert Gray. He's the chairman of the Debt Finance Advisory at HSBC. He was personally involved in designing the structure of that debt swap. HSBC, of course, one of the two banks that was called upon by the Greek government to execute the swap. Robert, you know, one of the things that you've been talking to me about just the last few hours or so is the complexity of that swap, and also it's exposed the, let's say, opacity of some of the rules governing European bond markets. Now, how is this a hindrance for investors who are trying to look at these markets?
I think a lot of the opacity comes from the very way in which governments approach their issuance of bonds governed under their local law. And I think what people have learned from this experience is that governments do have the power to amend contracts. Now, of course, in the Greek case, it was a relatively mild amendment. They just introduced collective action clauses into the existing Greek law debt stock. An action which, in fact, anticipates what all euro area governments will be introducing effective January the 1st next year. So it was, in a sense, a preemptive initiative by Greece. I think the more fundamental problem with the local law governed bond market, which in the Greek case that was 86% of the total debt stock, is the fact that the protections are different under local law bonds than for the same issuers international law bonds, areas like cross-default negative pledge, waivers of sovereign immunity. I think this is something that, coming out of this crisis, should be addressed by European governments, how to conform the protections that they give bondholders in their international and local law bonds, so they have the same type of protections. And I think that's something, a message that they've taken on board.
What are we going for in terms of that conforming? I mean, a lot of the bonds, some of the Greek bonds are being issued under UK law. Is the UK law a potential law that could become a norm for European issues?
Well, English law is a very popular modus of issuance for governments, and I think it's no coincidence that English law was chosen for the new bonds issued by Greece under debt exchange. I think the protections there are seen as strong. But I think the other problem, David, that we need to address in this market is the availability of prospectuses. I think, as you may be aware, European governments don't have to issue prospectuses under the Prospectus Directive. As a result, often it's hard to find the terms of issues that may be outstanding, particularly again for local law bonds.
So this actually confronts the whole issue of the opaqueness of the market. Tell me, when you were looking at the structure of the Greek debt swap, what were the other features that stood out for you there? Well,
of course, the main feature was this decision to use collective action clauses, because that ensured that a sufficient amount of debt stock was exchanged to meet the Troika's expectations, so approximately 95%. Which is an extremely high level, and that couldn't have been achieved without the decision to use the collective action clauses as a way to bind in all the bondholders in the case of the Greek law bonds. But I think another less well heralded innovation in this transaction was what we call the co-financing structure, whereby a trust was created and payments will be made pro rata between the private bondholders and the European Financial Stability Facility. So in a sense, this is the first time that an official body has agreed to kind of co-finance with the private sector. And I think this is a model that could be adopted very widely in the future.
Robert Gray from HSBC, thanks very much indeed for coming to speak to us.